Ever wondered what the difference between stocks, bonds, and mutual funds is? It's like opening a door to a treasure trove of opportunities, where every term weaves its own fascinating tale. Our journey begins with three key terms: stocks, bonds, and mutual funds. Each a unique path in the intriguing world of investments, each offering its own advantages and risks. Intrigued? Well, you should be. Stay tuned to uncover the mysteries of these investment options. First, let's dive into the world of stocks. Imagine owning a piece of Apple or Google. Sounds exciting, doesn't it? That's what buying stocks essentially is, acquiring a slice of a corporation. When you purchase a company's stock, you're buying a small piece of that company, becoming a shareholder. You now own a fraction of the assets and earnings of that company. The allure of stocks lies in their potential for high returns. If the company you've invested in does well, its stock price may rise, and you could sell your share for more than what you paid for it. This is known as capital appreciation. For instance, if you had bought a share of Amazon when it first went public back in 1997, your investment would have grown exponentially by now. But it's not all rainbows and sunshine. Just as the potential for profits is high, the risk is equally significant. If the company you've invested in doesn't perform well, its stock price may drop, and you could end up selling your share for less than what you paid for it, leading to capital loss. Remember, the stock market is volatile and influenced by numerous factors, including economic indicators, global events, and company performance. Moreover, some corporations pay out dividends to their shareholders. These are a portion of the company's earnings distributed to shareholders, usually on a regular basis. Dividends can provide a steady income stream, especially appealing to income-focused investors. It's also important to note that there are two main types of stocks: common and preferred. Common stockholders have the potential to make the most money since they get voting rights and dividends. Preferred stockholders, however, get preference when dividends are distributed and in case the company goes bankrupt. In essence, buying stocks is like a thrilling ride. It's about taking calculated risks for potentially high returns, being part of a company's journey, and sharing in its success or failure. So buying stocks means buying a piece of a company. Remember, with higher rewards come higher risks. Now, time to shift our focus to bonds. Imagine walking into your neighbor's bakery. He's got a new recipe for a potentially revolutionary type of bread that could change the culinary world. But there's a catch. He needs some financial help to get the project off the ground. So you lend him a chunk of money, and in return, he promises to pay you back with interest. Sounds fair, right? Well, that's the basic idea behind bonds. Corporations and governments often need to raise money for various reasons, maybe to fund research, build infrastructure, or even pay off debts. Instead of selling off parts of the company, like in stocks, they borrow money from investors like you and me. This borrowed money is represented in the form of bonds. When you buy a bond, you're essentially lending your money to the organization issuing it. In return, they promise to pay back your investment, known as the principal, after a set period called the maturity date. But that's not all. They also agree to pay you a little extra, known as interest, as a thank you for your trust and patience. Bonds can be a great way to earn passive income. The interest is paid out periodically, often semi-annually, until the bond reaches its maturity date. At that point, the principal is returned to you, and the bond is considered paid off. Now you might be wondering about the risks. Well, bonds are generally considered less risky than stocks. That's because unless the issuer goes bankrupt, you're guaranteed to get your principal back, along with the agreed-upon interest. However, keep in mind that lower risk often equates to lower returns. So while bonds might not offer the potential for explosive growth like stocks, they provide a more predictable and steady income stream. In essence, buying bonds means lending your money with the promise of getting it back with interest. Finally, let's explore the concept of mutual funds. With mutual funds, we're diving into a world where diversification and professional management come together to create an investment opportunity. Let's start with the basics. What is a mutual fund? Simply put, a mutual fund is a type of investment vehicle consisting of a portfolio of stocks, bonds, or other securities, which is managed by an investment company. Now here comes the interesting part. Mutual funds work on the principle of pooling. This means that they collect money from a multitude of investors, just like you and me. This pooled money is then invested in a wide array of securities, hence providing a level of diversification that might be difficult to achieve for an individual investor. So, why is diversification important, you may ask? Well, it's all about spreading risk. It's like the old saying goes, Don't put all your eggs in one basket. When you diversify your investments, you reduce the risk of one poor performing investment significantly impacting your entire portfolio. But that's not all. Mutual funds also come with the advantage of professional management. This means that there is a dedicated team of financial experts who make investment decisions on behalf of the fund's investors. They study market trends, analyze data, and use their expertise to make informed decisions. This can be a huge benefit for those who may not have the time or expertise to manage their own investments. However, it's important to remember that all investments come with certain risks, and mutual funds are no exception. Market volatility, management risk, and fees are some of the potential downsides to consider. Therefore, it's always advisable to do your own research and understand the fund's investment strategy before investing. In essence, mutual funds provide an opportunity for investors to gain exposure to a diversified selection of securities managed by professionals. They can be an effective way to balance risk and reward in your investment portfolio. So, investing in mutual funds means pooling your money with other investors to buy a diverse range of stocks or bonds. Now that we have a basic understanding of stocks, bonds, and mutual funds, let's compare them. Dive with me into this pool of financial knowledge. First, let's talk about risk. Stocks are generally considered the riskiest of the three. As a shareholder, you're directly affected by the company's performance. If the company does well, your stocks increase in value. But if it doesn't, you could lose your investment. Bonds, on the other hand, are less risky. When you purchase a bond, you're essentially lending money to an entity, like a government or corporation. In return, they promise to pay you back with interest. The risk here lies in the possibility of the entity defaulting on its payment. Mutual funds fall somewhere in between. They're a collection of stocks, bonds, or other assets managed by professionals. The risk depends on the type of mutual fund. For instance, a mutual fund that invests heavily in stocks would carry more risk than one focused on bonds. Next, let's consider potential returns. Stocks have the potential for high returns, particularly over the long term. However, they can also lead to significant losses. It's a classic case of high risk, high reward. Bonds offer lower returns but are generally more stable. You know exactly what you'll receive and when, provided the entity doesn't default. Mutual funds offer a balance. The returns are not as high as stocks, but they're typically higher than bonds. Plus, they provide diversification, which can help manage risk. Now let's discuss management. Stock investing requires a hands-on approach. You need to research companies, monitor performance, and decide when to buy or sell. For bonds, it's a bit simpler. Once you've purchased a bond, you just wait for it to mature. Mutual funds, however, are managed by professionals. They make the decisions about what to buy or sell within the fund. This can be a major advantage if you're not comfortable making these decisions yourself. Each of these investment options has its own benefits and drawbacks. Stocks can offer high returns but come with significant risk. Bonds are more stable but offer lower returns. Mutual funds provide a balance of risk and return and are professionally managed. The key is to understand your own financial goals and risk tolerance. Are you looking for high potential returns and willing to accept more risk? Stocks might be for you. Do you prefer stability and predictability? Consider bonds. Or are you looking for a balance of risk and return with professional management? Mutual funds could be a good fit. Remember, there's no one-size-fits-all answer. It's about finding what works best for you and your financial goals. Each investment option has its own set of benefits and drawbacks, and understanding them is key to making informed decisions. Investing can seem daunting, but with the right knowledge, it doesn't have to be. So let's recap. We've journeyed through the fascinating world of stocks, bonds, and mutual funds. We've learned that stocks represent a slice of ownership in a company. As a stockholder, you stand to gain when the company does well, but you also shoulder the risk if the company doesn't perform as expected. We've also delved into bonds. Bonds are essentially loans that you give to the government or a corporation. In return, you receive your initial investment back, plus interest over a set period of time. While bonds are generally considered safer than stocks, they typically offer lower returns. Then we explored mutual funds, a sort of investment buffet. By pooling your money with other investors, mutual funds allow you to diversify your portfolio and minimize risk, all while being managed by professional fund managers. But no matter the investment vehicle, stocks, bonds, or mutual funds, the key to success lies in understanding these options. It's about knowing the risks, the potential returns, and how they align with your financial goals. It's about doing your homework and not just following the latest trends or tips from a friend. So, equip yourself with knowledge, ask the right questions, and don't shy away from seeking professional advice. Remember, investing is not about following the crowd, but understanding your options and making informed decisions. Happy investing!